Hi, I'm Dan Danford, and we're doing another episode of Money Made Easy for dadsdivorce.com. This week's question from the website is a good one to start with. I've heard a lot about debt consolidation, and it sounds like it might be a viable option for me to help me get out from under significant student loan and credit card debt. But does debt consolidation negatively affect your credit rating? A lot of people are concerned about their credit rating, and that's why this is a good question. Basically, the credit rating companies are evaluating your ability to pay off new loans. That's their whole purpose in existence, is so that when the car dealer or when your bank is considering your loan, they go to one of these credit evaluation companies and they have a score, and that score helps them decide whether or not they should loan you money. Now, everything about credit rating is about your ability to pay off loans, okay? And it's based on your credit history, among other things. So anytime you can pay off loans or pay down loans, that will help your credit rating, okay? It's that simple. Now, the notion of doing credit consolidation can be helpful in accomplishing that. As a matter of fact, today's a great time to do it. Interest rates are as low as they've been in the last 40 or 50 years. So today is a perfect time to look at debt consolidation. Now, there are a couple of key things to look at. Basically what you're doing is you're taking a number of smaller loans and combining them into a larger loan. And then you just have to make one monthly payment every month towards retiring that larger loan. Okay? You can do that, and lots of times it makes a lot of sense. One of the hazards, though, is that once people have done that, then they go back to borrowing on those credit cards and stuff again, and they build up balances all over again. So that's a bad thing to do. Okay, that isn't going to improve your credit score. But if you can do it, if you can consolidate to one large loan and you can pay off that loan in a timely manner, it will improve your credit rating. It's a big step forward. And today's a good time to do it because you might take a number of smaller loans that you have that charge high interest rates and roll them into a larger loan which has lower interest rates. So not only will you have an easier to manage situation, but the cost of interest will be lower as well. But it's really important that as you bring that debt under control through that consolidation or whatever, that you not build up new debt on the side. And one last thing that I'll add to your situation is you need to go directly to student loan debt consolidators as opposed to consolidating with a home equity loan or something like that. Because student loans have special rules and special interest rates and all that kind of thing. There are companies out there, you can do a search on the internet if you want to. There are companies out there who specialize in student loans, and they may be able to help you take 3 or 4 different student loans and roll them into one so that it's easier for you to take care of. But don't necessarily just go to a bank or to the mortgage company that has your house and take out a second mortgage and then pay off those student loans. Just need to be real careful about doing that. In general, the idea of consolidating debts to help you manage them is a good idea. You just need to be very careful when you do it and make sure that you don't replace old debt with new debt. Okay? Use it to your advantage. Be smart in how you do it. Now's a terrific time to be looking around for opportunities to bring your debt under control. That's it for another episode of Money Made Easy. I'm Dan Danford, and I'll see you again next week.